Hi, and welcome to the Finbox Academy. In this video, you will learn how to conduct a sensitivity analysis in Excel with a detailed step-by-step guide. What's more, we've prepared for you a sensitivity analysis template, both for Excel and Google Sheets. You will find the link to download them for free in the description below. Before we start the guide, let's go over the basics of sensitivity analysis. Are you ready? Let's start. Sensitivity analysis is an analytical tool that lets you assess how a dependent variable, such as the intrinsic value of a stock, changes if you alter one or more independent variables, revenue growth, tax rate, and so on. If you are an investor, you already know that most of our investment decisions are based on future estimates. For example, while evaluating the intrinsic value of a business, we estimate the future cash flows it can generate based on several assumptions, such as revenue growth, tax rate, EBIT margin, and so on. The question is, what happens to the intrinsic value of the business if one of our assumptions changes? This is where sensitivity analysis comes in, and this is why it is also known as what-if analysis. There are two main types of sensitivity analysis. The one-way sensitivity analysis, if you analyse changes in the value of just one input, and the two-way sensitivity analysis, which occurs if you vary the value of two input variables. If it's still not 100% clear, it will be with an example. Let's say that you want to check how a change in the exit multiple and the tax rate would affect the internal rate of return on an investment. 4 months ago, I published an analysis of Fresenius, where I performed a two-way sensitivity analysis to evaluate that, and this was the result. The exit multiple is used to calculate the terminal value of a business while performing a discounted cash flow analysis. Even if we carefully select the ratio value with the appropriate methods, past trend, industry average, peers, etc., it is still an arbitrary number that moves the needle in our model. For this reason, we should always check how a change in its value impacts our valuation. Furthermore, I wanted to see how a change in the tax rate impacted my valuation. As I wrote in the analysis, the 2020 presidential election could be an inflection point for the corporate tax rate, as you can read in the Deutsche Bank report in the description below. I hope this sensitivity analysis example made things clearer. Now we can move to Excel for the step-by-step guide to sensitivity analysis. Let's start with the one-way sensitivity analysis. What this simple table tells you is that you'll obtain a 20% CAGR on your investment if the company's EPS grows by 20% per year for the following 5 years and its PE ratio in 5 years is 29.6. A change in the EPS growth could significantly impact your investment return. For this reason, you decide that the best thing to do is to perform a one-way sensitivity analysis in Excel. The first thing to do is to create a table like the one below. You have to insert your current CAGR in the column and the EPS growth variations in the rows. After you create the table, follow these steps to generate a data table. Select the table, go to Data in the ribbon, select What If Analysis, click on Data Table. When you click on the data table, you'll see a pop-up like the one below. Insert in the column input cell the variable you want to analyse and leave the row input cell empty, because this is a one-way sensitivity analysis. You can now observe how your investment return changes based on EPS growth. Now that you've learned how to perform a one-way sensitivity analysis in Excel, let's create a two-way table. As we mentioned before in the two-way sensitivity analysis, we sensitize the output for two variables. The first thing you need to do is to create a table like the one below. You have to insert the output you want to sensitize on the top left corner, and then your variables in the adjacent columns and rows. Once you create the table, follow the same process described earlier to generate a data table. Select the table, go to Data in the ribbon, select What If Analysis, click on Data Table. This time, we insert in the row input cell the F9 cell, PE ratio forecast, and the F8 cell, EPS forecast, in the column input cell. You can now observe how your investment return varies based on changes in the EPS growth and the PE ratio forecast. It may be helpful to view the spreadsheet I created at the end of the process. You can check the links in the description to download a free sensitivity analysis template. Just a little tip before you go. Do you know that researchers demonstrate 90% of spreadsheets have errors? That's often because of manual data entry. With the Finbox Excel add-in, you can get the latest financial data directly in your spreadsheets and improve accuracy by pulling the latest data instantly into Excel or Google Sheets with a single formula. Once you've developed a financial model just the way you want, you can reuse it for a different security just by changing the ticker in the spreadsheet. It won't just help you to avoid errors, but to make things easier and quicker. The custom FNBX function allows you to import stock quotes, historical financials, valuation ratios, fair value estimates, and more. Before you leave, don't forget to subscribe to the channel, because in the following days we'll publish new videos that will help you improve your financial modelling skills for free. See you at the next lesson.